Wouldn't it be so amazing if your business wasn't taxed? Or you could use it just as a pass-through entity for all your funds, relieving the business of any tax liability? Well, in this video, I'll show you how to use the K1 tax form to do just that. But before that, please make sure to subscribe and like this video if you want to be in the loop with the latest money tactics on how to increase your wealth. The US tax code allows certain forms of entities to utilize pass-through taxation. This effectively shifts the tax liability from the entity earning the income to people who have a beneficial interest in it. The Schedule K1 is exactly that, the form that reports the amounts that are gone through to every party that has an interest within the entity. K1 forms for business partnerships. For businesses that operate as partnerships, it's the partners who are liable for paying taxes on the business's income, not the business. Each partner is to blame for filing a personal instrument reporting their share of income, losses, tax deductions, and tax credits that the business reported on the informational 1065 form. As a result, the partnership must prepare a Schedule K1 to report each partner's share of those tax items. K1s are provided to the IRS with the partnership's income tax return and also to every partner in order that they'll add the data to their own tax returns. For example, if a business earns $100,000 of taxable income and has 4 equal partners, each partner should receive a K1 with $25,000 of income. Schedule K1 for S corporations. Similar to a partnership, S corporations must file an annual return on Form 1120S. The S corporation provides Schedule K1s that reports each shareholder's share of income, losses, deductions, and credits. The shareholders use the knowledge on the K1 to report the identical thing on their separate tax returns. K1 forms for trusts and estate beneficiaries. Trusts and estates use Form 1041 to file their tax returns. In some cases, the trust pays the tax on their earnings instead of passing it through to the beneficiaries. However, some trusts and estates pass income through to the beneficiaries. In this case, the beneficiaries receive a K1 that shows the income that they have to report on their own tax returns. Whenever a beneficiary receives a distribution of income, the trust or estate reports a deduction for the identical amount on its 1041. This keeps the trust or estate from being taxed on this income, so the income is barely taxed once. Schedule K1 reporting. The Schedule K1 is slightly different looking on whether it comes from a trust, partnerships, or S corporation. However, all K1s provide detailed information about the kind of income, tax write-offs, or loss, so you'll be able to accurately report the knowledge on your return. That's all I had for today. Thanks for sticking around, and I hope that this video was able to help you understand the benefits of a K1 tax form. If you liked my content, please hit the subscribe button at the bottom so that you stay updated about all the new content I made regarding finances, investments, and the business world. Stay well and see you in the next one.